Attendees are in listen-only mode.
Okay. Hello everyone. Hello, this is Admiral Markets webinar. There was a slight mistake in our title. It's called, our webinar is called Momentum versus Leading Indicators. It's not Momentum versus Lagging Indicators. It's Momentum versus Leading Indicators. So after Mikhail finished with his speech about platform, about investing in general and Forex market, I will show you basically what are momentum indicators, what are leading indicators, how you can use and combine them. I will give you a system so you can see and you can start practicing on demo account. I will show you a system which combines momentum and leading indicators. Beware, this is just to have in mind, this webinar is for new to moderate traders. So I will give you all hints to know what are momentum and leading indicators. Also, guys, I will show you exactly how we use those indicators to our advantage. There were some questions last webinar. Also, I had some private questions on my email about indicators in general, or why I use indicators. You know, just before Mikhail enters, I will tell you a few things. I'm basically a price action trader. I'm a price action trader, and what I do is I really prefer to trade pure price action. But whenever I do analysis, I show you the screen with chart patterns and so on. And this is my analytics screen. I use it for my analytics. For entering the market, I use MACD. MACD is my preferred indicator, but also I like to see the price bouncing off or thrusting through a level. So this webinar will show you in basics what are momentum and what are leading indicators. Now Mikhail, I think that he's been logged in. I will let him speak, so after he finishes, be sure to stay with me and I will show you what I have in mind. Okay. Mikhail, go on.
Good afternoon, ladies and gentlemen. Thank you very much for such a lovely introduction, Ninat. I will now switch the presentation mode to my screen. There we are. I hope everybody can see me. I wish you all a very good evening. I hope you're going to have a lot of fun today and you're going to learn a lot of new things. My name is Mikhail Onahov and I'm a Client Relationship Manager at Admiral Markets. In essence, my job is to create the best trading environment for you. Today I wanted to speak to you about something a little different. Let's take a break from charts, numbers, and currency pairs. Let's forget for a minute about Japanese candles and Fibonacci lines. Today I wanted to speak to you about something that concerns every one of us. I wanted to speak to you about self-improvement, because self-improvement has been a hot topic for a number of years now, and all we do constantly is we try to invest money, time and efforts into personal growth, and this is very understandable. In this day and age, you must grow and develop yourself on a constant basis. We rely on books, we develop ourselves in schools, universities, we carry on in our professional careers. It is just like an investment. Yourself in the future must be more than you are just right now. Just like a future is more than a spot price, yourself in the future must be smarter and better equipped than you are today. All of you took time to attend this webinar today, and I think all of you have made a right choice. You decided to invest into yourself, to invest in your future development in order to become better in the future. You want to learn new things, and tomorrow, after you have watched this video, you'll be smarter than you are today. But I would not advise you to stop here. You have entered a whole new world, a world of investment, where money is made and lost, a world that is a battlefield for the brightest minds of our generation. Some of you are just considering to enter this new and exciting world. Some of you have taken some steps in order to explore it. Some of you are living and breathing investments. To those of you who are still considering to invest or not, consider the following. Once you enter the world of investment, you will change, and you will never be the same again. You will be better. Not only does investment give you a chance to earn, because no one can guarantee you a win. What I can promise you though, what I can guarantee you is this. Your horizons will broaden. Forex is a demanding investment field. You will be required to follow the news, and you will be surprised how much involved in current affairs you will become in just a few weeks. Technical fundamental analysis will give you information in order to make a correct split-second decision. Your analytical skills will improve. And this is a tool that will help you not only in the financial market, but in all aspects of your everyday life. Decisiveness. Now, Forex trading is all about decision making. A second can separate a profit from a loss. And you will learn this skill. You will be one calling the odds. You will take this skill from the financial market and you will apply it to everything in your everyday life. After all, isn't life all about decisions too? You will see for yourself. It will no longer take you a few minutes to choose a meal in a restaurant, and this will be just a modest beginning. But let's talk about something important. Let's talk about the most important thing. One day you'll take a loss, and it will hurt, but it will happen, because it happens to everybody. But once it happens, you will learn the most important skill, self-discipline. Believe me, money is a great motivator, one of the great and the best motivators there can be. And it will teach you that a profit is not a product of luck. It's a product of hard work and dedication. Those of you who invest regularly will agree with me. Investment is a trip worth taking. Mark my words. Register a real account today and make your first trade and see what happens. In a year, you'll be able to look at yourself and you will understand that it was not just a financial affair. It was a great learning experience. Some of you will make a loss. Some of you will make big profits like a lot of traders do. Your lecture today is actually a pretty good example, but all of you, 100% of those who enter the world of investment and forex trading will be a better person. Knowledgeable, decisive, and disciplined. Guaranteed. So, if I was able to buy a derivative on you, I would long you in a second, because I think that everybody who is present here today are destined to do great things in the future. Thank you very much. It's been Mikhail Onokhov. I will now pass the microphone over to Nenad, who will talk about today's subject. Thank you very much.
Thank you, Mikhail. Thank you. Thank you very much. And now we can start with our webinar. Also, what I have in mind, maybe last 2 or 3 months, I will speak with Admiral Markets organizers and so on. So maybe in the future we will have some sessions recap where I would like to tell you maybe setups for well, my views, basically my views for next day for euro, dollar, cable, or Aussie. So maybe we will see about it also. So that is what I had in mind. But now let's talk about momentum and leading indicators. Of course, risk disclaimer is always the same. By accepting the risk disclaimer, you will proceed with us, and we can, of course, proceed with today's agenda. Today's agenda is what are Forex indicators? Classification, momentum versus lagging indicators, and sorry, this is a mistake, this is leading. Trading strategy based on both indicators. I will give you a trading strategy. So now remember now what I'm telling you. Leading indicators are oscillators. Lagging indicators are momentum indicators. So this is a slight mistake. This is it should be momentum versus leading indicators. So don't get confused. This was a typo, and now I will explain you what basically I think about all of those indicators. So what is an indicator? An indicator is something that tells us something. That is, well, that is basically a price action copy which looks like a line or like whatever founder of indicator want it to be. So indicator is basically well, a copycat of price action. But there are few things that differ it. It is indeed a mirror of price action, but all indicators are mathematically calculated, and those are all calculated based on a price. So there is no variations. There are some algorithms, there are some measures, there are some exponential equations and so on, but all indicators are mathematical calculation. Statistics used to measure current conditions as well as to forecast financial or economic trends. Those are indicators. Leading indicators predict price. Lagging indicators tells the truth. Now, listen to me very carefully. I know that most of you are using indicators to tell you when to enter the market. Well, basically, it can be a good thing, but from my experience, longer term, you will lose if you only use leading indicators. I will show you what leading indicators are, what lagging indicators are. But leading indicators have more disadvantages than lagging indicators. And that is the truth. That is, I know maybe some traders won't agree with me, but my practice and my work on Forex market has indeed showed me that leading indicators can be very nasty. If you follow me, if you follow my work on Forex Factory, mostly on Forex Factory, you would probably remember that 2 years ago I posted some setups using purely RSI indicator. And indeed, RSI indicator was good in time, and that trading strategy which I used purely on RSI was good. But you know, when market conditions change, we are all subject to fear because our system or strategy don't work, right? It doesn't work. So we need to adapt to market conditions, right? And my practice has shown me that always the best thing is to combine those. Don't use strictly one indicator and don't use strictly another indicator for showing a prediction or reaction to price. So we need to combine leading and lagging both, because one without another is basically a subject to a potential loss. But let me tell you again, solely speaking, leading indicators have more disadvantages than lagging indicators, and I will show you why. And now I'm not talking about the price as leading indicator, because for me, for myself, price is basic indicator for me, price action. I like to use candlesticks, and those are my indications. I just use, well, those lagging indicators for confirmation of the trend. And I want to see a confluence around important levels. So the main purpose of using indicators is to define trend, to confirm a trend and entry, and to place stop loss and target price or take profit. So those are all purposes of using indicators. Mostly for you traders, you use indicators to have profits, and you use indicators to lessen the risk of unplanned price movements. So now here are leading indicators called oscillators and lagging indicators called momentum indicators. So this is leading versus lagging, right? Leading versus lagging. Now, what is a leading indicator? A leading indicator is an indicator that gives you a signal before the new trend or reversal or retracement occurs. A lagging indicator gives you a signal after the trend has formed and tells you that basically you need to decide when to enter the market based on current trend if you are a trend follower. So, well, I will show you later what are some disadvantages, but basically these are all advantages of those indicators. Most famous indicators are CCI, RSI, stochastics, and Williams percent range. Those are oscillators. So they give you the price which usually turns into a reversal or into a trade entry, right? Into a reversal or into a trade entry. Lagging indicators, momentum are MACD, my favorite, RSI, momentum, rate of change. Some use, as Chris, my colleague, he uses awesome oscillator. Well, this is also a double, how can I say, double thing. Awesome oscillator also as MACD can be also a leading and lagging indicator. But let's say that MACD is more momentum indicator. I don't use MACD for entries. I use it for divergence setups, and I use it for telling me that the trend, let's say on 4-hour or daily or 1 hour, has formed. I know to define, and we all know to define the trend, right? Uptrend, downtrend. But MACD has some great calculations to tell you that maybe the current trend will reverse by using divergence, and also that can be used to enter if we have a building thick, let's say green bars above the waterline. So this is one of examples of using MACD indicator. So this can all be a very, very good if you combine it with something, right? With CCI or RSI or, I don't know, Williams percent range. This can be a good thing. But eventually, after maybe years of trading, you will get back to basics, and those are price and few indicators. Let's say MACD or maybe stochastics, and that would be all. You wouldn't need anything to be successful trading. If you remember my webinar, and Chris, last time we talked about psychology. Psychology is the most important thing in Forex trading. Indicators are not. Indicators just show you some things, but they're not most important, right? Most important is your psychology. But now, also, because probably you're new to trading, you need to know about those indicators. You need to know what they represent. You need to know the truth behind all indicators. So, let me tell you again, leading indicators are not the same as lagging indicators. They're completely different thing. And I mean completely 100%, right? 100% different. Leading give you the price and prediction and can tell you the entry. Lagging indicators give you a trend after it has been confirmed. And there are third part of indicators which are basically dynamic levels of support and resistance, and those are moving averages. Simple exponential, smoothed, and linear regressed moving average. So those are classifications of indicators. Most important are oscillators, leading, momentum lagging, and moving averages. I will tell you that I never ever use cross of moving average for entry. And now for all of you who listen to this webinar, I advise you, don't use cross of moving averages for entry. There are some examples, let's say good examples with 513 cross of moving average, but in the long term they lose, guys, they lose. I know they lose. And I know a guy who, I won't tell his name, but I know him. He presented himself on the web. He's very famous for his Bollinger Bands 513 cross of moving averages. His system, I won't say a name, but I know him. And he was a loser. I watched him trading live. That system which he used was the biggest fail. As we say, epic fail. He used Bollinger Bands in combination with moving averages. And what happens is, if you use crossovers of moving averages, you will get many false signals. You will get false signals because moving averages are laggy by their nature. They are lagging. You know, they are not showing the exact movement. They're lagging behind the real price, and they are excellent tool. They are excellent tool for determining dynamic support and resistance levels. They are perfect, almost perfect. Well, in Forex market, nothing is perfect, but let's say almost perfect. So I use it simply to determine dynamic levels of support and resistance, and to determine, let's say, historical buyers and sellers, right? Historical buyers and sellers. And that is the pure explanation of moving averages. I can tell you in details what are calculations for simple exponential. Let's say maybe later, if we have the time, I can tell you what is simple, what is exponential, what is smooth, what is linear, but that is not important to you. You just need to know that moving averages are lagging indicators, and the idea behind the creation of moving averages was rather simple. Price action is thought to fluctuate around the average value over a period of time, and then we can expect to be able to represent the market's momentum by calculating if the current prices are above or below the market's average value. So that is basically what moving averages are for, right? We use it, and professional traders don't go with crossovers. They use it to determine support and resistance levels. So what are the advantages of oscillators, and what is disadvantage, and what is momentum, and what is disadvantages of momentum indicators, lagging indicators? Okay, oscillators are a group of indicators that confine the theoretically infinite range of the price action into more practical limits. So they were developed due to the difficulty of identifying a high or low value in the course of trading, because traders have different views. I can say that euro today gave me a top. I told you, I showed you on my analysis. It was 32.75, right? If you watched my analysis on Admiral Markets blog, Forex Factory, Worldwide Investment, and Admiral Markets Facebook page, you saw that my arrow pointed to 32.75. We have reached 32.75. It was inverse head and shoulders pattern. The neckline has been broken. It was retested, and the price went to test 32.75. And now, what I'm trying to say, the view, or for example, my view of that level, 32.75, is not the same as the view of another 100,000 traders, right? Some saw it that it will break 32.30. Some saw it to 32.50. Well, now what I'm trying to say is that indicators are developed due to the difficulty of identifying a higher low. So most indicators will tell you, okay, 32.55 is the top, right? 32.55 is the top. Now we can try to see if there is a short trade. But what happens is that, well, it's not exactly always like that. That's why most of those indicators cross some lines, let's say stochastic cross of 80 or 20 level, to confirm that you can take a short entry. So let's say that oscillators determine turning points. This is the most important aspects of oscillators. They determine turning points, so you can try to enter long or you can try to enter short. A good example is for stochastic indicator, right? So although we may have mental concepts of what is high or low in a typical day's price action, Forex volatile and chaotic nature means that any high can easily be superseded by another one that sometimes follows on the heels of historical buyers or sellers and negates it swiftly. So oscillators aim to solve the problem by identifying indicator levels that hint at tops or bottoms and helping our decision process, right? So that is why oscillators were basically developed. They want to hint you the top and bottom. They want you to point you to enter long and short and point you to say this is overbought or oversold. But the main problem is that they can generate a lot of fake signals. Now you will ask me, if they generate a lot of fake signals, why we should use it? Well, there are two ways of using oscillators. One is to determine turning points, tops and bottoms, and that style is good and useful if you trade range. That is good. Oscillators are great in ranging markets. They can give you a range, and well, by applying a relatively small stop loss, you can profit from, you can make good profits, right? So oscillators are basically aiming to give you turning points on ranging market, right? Leading indicators are something different. They hint that the trend has already started, and that is, for me, that is very, very useful. For example, MACD on 4-hour time frame or 1-hour time frame. So let's say let me explain you what basically momentum is. Let's say, for example, we all know that the speed of a swinging pendulum will vary along its vertical axis. As the pendulum, let's say, moves from the bottom to the top, it's called oscillation, right? But with every move, it gains momentum. Although the vertical movement of the pendulum is zero at the top of its range. It's zero, because if there was no that zero momentum at the top, it would fly away. The forces acting on it gives us the maximum. They give basically the maximum of that range. So as the pendulum reaches its maximum speed, the forces generating the speed are at their minimum. So the oscillation of force and speed that creates back and forth movement of the pendulum is very similar to the oscillation of prices in the market. We need to see that the momentum is going up. For example, today we saw that momentum was going up. We had bad NFP results. Dollar is yet again heavily weighted because USA now is thinking about whether they will attack Syria or not. So that has all negative impacts on dollar. But momentum has been gathering from the Friday close. And today we saw that Aussie also broke that 22.20 level. Again, Euro broke 32.05 neckline. So it was all gathering momentum until the breakout. But we know that the price basically was bullish. The price was bullish. So, well, guys, as the price moves between successive extremes, the trend will continue to generate new highs unless the continuous nature of the price action is broken by an unexpected event. So that is a good example of momentum. We have momentum until it reaches its maximum point, and its maximum point is not determined by any indicator. It's predetermined by, well, by big banks and hedge fund traders. If they think the same, basically, if they think that the 32.75 or 32.70 will be the top, and they place their sells around 32.70-75, it will indeed be the top, and the price will tend to lose the momentum until it reverses. So reversal and retracement are not the same. Reversal is when the price completely reverses from the trend, and retracement is another part of the trend. So you cannot say that reversal and retracement is the same. Momentum indicators are very useful in trending periods. The only disadvantage is that using it we miss a part of the trend. We can miss, well, as you know, the earliest possible entry is divergence entry, right? But if we miss divergence and if we use some lagging indicators, well, we usually miss the part of the trend. But the part of the trend is not to take 20 pips, right? The trend usually starts with, I don't know, 50, 100, 200 pips. So we can, if we are in the trend, we can profit from each retracement, right? We can profit from each retracement. So that is the main purpose of momentum indicators. Momentum indicators portray those swings of the pendulum, what I was talking about. Well, there are no precise rules in trading and technical analysis that can give perfect results. But momentum indicators do help us to place the price action into the context of trading possibilities, which enables us to be more determined, if you understand what I mean. They give us additional confirmation. So we are more determined to enter the trade. So we don't go with that parole, if you remember our last webinar, paralysis by analysis. So there are many good traders, but they are good analysts, but they cannot take a trade. They are afraid to take a trade. Well, by using of these indicators, let's say momentum indicators, we indeed miss a part of the trend, but we have a good confirmation, our psychological also confirmation, that we are indeed right, so we will take an entry. So that is basically what oscillators and momentum indicators are. Oscillators, as you know, gives us entry turning points, while momentum indicators gives us the trend direction, and they tell us that the trend has already started, so let's join the ride. Let's join the ride. That is the purpose of that indicator. Now this is a trading strategy which I will show you, but let's just talk a little bit about moving averages. Just let me tell you a few things about moving averages so you will know what basically those moving averages are. Simple moving average is the most basic of all simple average tools. It sums the closing price over specific time and divides them by the duration of that period. There is no weighting and there is no smoothing factor any in simple moving average. That is the simplest form of using SMA. Exponential moving average is maybe the most prominent moving averages because it gives us greater value to most recent prices. Its weighting is done exponentially. So let's say that we move to the left of the chart and the weighting that they receive in computation on the moving averages decrease rapidly. So the most recent prices are far more significant. As a result, they determine the value of the indicator. So exponential moving averages is, well, they're, for me, in some trading strategies, they can be more useful. They can be more useful than simple moving average. But also there are some good strategies which are only pure simple moving averages. So basically, the only maybe advantage of EMA is that more traders use it, and the more traders use it, the more the chances for better trades are bigger, right? Are bigger. Smoothing moving average is similar to exponential, except it takes all available data into account. The earliest price values are never discarded, but they receive a lower weighting and possess a smaller role in determining the value of indicator. Smoothing moving averages are used only in some systems that I saw it over the internet. So they are not very accurate in their well, determining of entry points and exit points. Linear regress moving averages is LMA, and those weighting factors are linear and not exponential. Linear regress moving average can be a great tool. It's a bit complex tool for using. You can try to search for some systems that use linear regress moving average. It's also called linear regression. But well, let's say that the most recent prices are emphasized in LMA, so latest and also latest fluctuations. So well, it's all better in aiding trading decisions. So that is basically, but I can say I cannot now explain the whole theory behind linear regress, but they can be used even better than exponential moving averages for guys who know how to use it. You can try to search on Google for LMA studies. They're really good, and there were some good systems. There were some good systems that showed really how LMA can be used to your advantage. I need to say also about Williams percent range. That indicator is good basically. And it's, well, Larry Williams created that oscillator, well, basically as the copy of the stochastic indicator. But it's without the smoothing component and with a reversed scale. So Williams percent range is very good in determining reversal. And even that indicator, it was made to reverse a trade in future. So it's used for also for overbought and oversold conditions, but also a potential reversals in market trends. I will show you later the system which you can use to actually try it. So maybe you will be successful. Why not? It's a good start for you to know about those indicators and to see how they behave. And the system actually was better than most of those which are sold at the internet. So let me talk just a little bit more of a Williams indicator, because that indicator is also used in that system, which I will give you a few words. Williams percent range also uses two values. Those are two values is -20 and -80. So if you see, you compare to stochastics, those are reverse lines, -2 and -20. But well, values between -80 and -100 are interpreted as a strong oversold condition or selling signal, and between -20 and 0, a strong overbought signal. And that means buying, but that is reversed. Now, if you paid attention, I said it correctly. It's reversed from stochastics. If it's oversold, it's selling signal. If it's overbought, it's buying signal. It's completely reversed from stochastics. And this is combining leading Williams, momentum RSI, and moving average as lagging indicator. So in this strategy, we will combine those indicators. And actually, I encourage you to try this strategy on demo account. I think that you use this strategy. This strategy is used on 5-minute time frame. So you can use your pivot points, or if you want. But basically the concept is for this strategy is very interesting. Now I will switch to pen mode. So we use these indicators. Williams percent range set at 21. We used RSI 9. Now we use RSI as momentum indicator. As I told you, RSI can be also a leading indicator and it can be used as momentum indicator. Now in this strategy we use it as momentum indicator, and that gives us a signal that the trend has already started and gives us signals that the price is indeed in a trend mode. So now we use RSI as momentum. MA we used as lagging indicator, but also as dynamic support and resistance levels. Now there are some rules. 40 MA must be above 80 MA, and then we wait for pullback to or close to 40 EMA. I will show you later on charts, so you will see what I mean. So what does this basically mean? 40 EMA moving average should be above 80 EMA, right? And the price, if it's here, we need to wait to pull back to close to this 40 EMA. Why we use pullbacks? Because we want to exploit the earliest entry possible in the trend, except if we use divergence. But we don't want to buy into resistance unless we are very sure that the price will move further and that momentum is high. Now, I occasionally do that as breakout trades. I usually, if I see that momentum is huge and that also daily momentum is big, I can buy into resistance to exploit those momentum breakouts. But mostly we want to see that the price is retracing, and then we want then another swing up. And that is why we want this. 40 MA must be above 80 MA, and then we wait for the pullback, right? We wait for the pullback. Williams percent range must be below minus 80, and then go through and close above minus 80. It needs to go below minus 80 and then go through minus 80 and close above minus 80. RSI must be above or at 50 and going up. If this is RSI indicator, this middle line is 50, right? It's 50 level. We want indicator which is set at 9 periods. We want that indicator to be above 50, right? We need to be here at 50 or above 50 and going up. We trade towards 5-minute and 1-hour resistance. So this is short. This is good example for long trades. Now pay attention to this indicator, to this chart. Let me see. Pen. Okay. Let's say that this is a resistance which we have determined by using manually drawn lines, indicator, and indeed this was 1-hour resistance. I have not cherry-picked it to show you exact chart. I really saw it as resistance as I was scrolling to the left of the chart, and I saw that this was indeed a resistance. So what I was implying is we want the price to, well, first we want to see if 40 and 80 here is converging. So converging and diverging. You see how those lines are going from each other. They are diverging. So we want to see this. This is good example. Convergence, then divergence. You see, red line and blue line forming a trend. Then we see here is the swing. The trend has been formed here. We also see that in this point, oscillator is going to minus 80, but is going up. Here, it's going up. This candle, this is that candle. Also, RSI confirmed momentum by going above 50 and it's going up. You see, it's going up. So this is, at this candle, this is our entry. Our stop would be below this, and we trade towards 1 hour resistance. You see, it's rather simple and it's not complicated. This example also, let's see this example. Here, it's above 50, and here is another entry which is later profitable, right? See how the trade has been profitable here. So basically what we do here is we combine leading and lagging indicators to give us a stop or entry and trend. For trend we use 40 and 80. Also we use it to determine dynamic support level here. For leading indicator we use Williams to tell us when to enter, and for confirmation as momentum lagging indicator we use RSI. So here in this example, when RSI is set as 9 and 50 level, that means that RSI is used as momentum indicator. I will answer to your questions just after I finish the webinar, so I will explain what I mean by 1 hour resistance. Don't worry. Let's say another example. Another example here. This is a sell example, right? Okay, first we determine 5-minute or 1 hour support. This is 5-minute support. But an indicator, which is called hourly pivot points, this also shows 5-minute and 1 hour support. So this is support and it's been established. You don't need indicator to see this. You see the price, you see the price, you see the double bottom and retrace. So this is support. Also, you can count the candles, 1, 2, 3, 4, 5, 6, 7, 8. More than 12 candles haven't breached this level, so this is also 1 hour support. Now you understand what I'm talking about. First we had swing to the downside. Double bottom has been formed. Then we have more than 12 candles not being able to break to this low here. So this is indeed 1 hour support, because more than 12 5-minute candles have not been able to break to this low. So this is 1 hour support. And now we want to swing. We wait, and here we see that the price is basically closing to 40 EMA. The first rule, if you remember, is retracement. We want the price to retrace as close to 40 EMA as possible. This is the level where price has been retraced. Now we need to wait for a second rule. We want to see a Williams percent range going from -20 to below -20. We want this oscillator to go like this. So this is the place where oscillator has made its movement, but we see that RSI, now used as momentum lagging indicator, hasn't given us the signal to go short, right? Now we need to wait for RSI. Here is the perfect alignment, here where this red line is. You see, red line. This will be a little bit clearer. Here, at this candle, Williams percent range turned the price. You see, it showed us that the price has been turned. Also, it has already touched 40 EMA, so this first rule has been respected. The second rule has been respected, and ultimately, you see here, it's going down, it's below 50, ultimately the third rule has been made, and we can enter a short trade. This is the first target, and this is our stop loss just above this. And you see how now, you see how this blue line ATMA show a good resistance. The stop loss is placed just above this candle, and it means just above this blue EMA. So this is a very good example of a system that you can use to your advantage, guys. Why not use it to your advantage? Now the question is, what do you mean by 1 hour resistance? You can use this example to determine support. On our very next example, 1 hour resistance, I saw that the price was, this was resistance given by hourly pivot point indicator, and also it was historical resistance. I flipped the chart to the left and I saw that this was historical resistance. You can use, as I say always, for scalping and for smaller swing trades, you can use a good indicator called IBFX pivot points. It's hourly pivot points, and they can really show you how to successfully enter the market by using pivot points. So this is basically my manually drawn line and also hourly pivot point indicator. So that is 1 hour resistance. But also you see here how you calculate this support. Just wait for the price to reach its bottom, then wait for retracement. This is retracement. Count the candles: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is the end of the hour, top of the hour. You see that the price hasn't broken this low, so this is hourly resistance. You can safely trade off the resistance into the support if you want to be counter trend trader, but this is counter trend system, so you want the price to go to retrace to red line, then follow these two additional rules. So you can use this kind of strategy, guys, to your advantage. If you have any questions, I will gladly answer. If you don't have any questions, I encourage you to listen to this webinar yet again and to see if you can profit from such good setups as this. This is one of good indicator-based strategies, so you can use it for scalps and scalp swings. Also, what I had in mind is, well, I will see. The next webinar is a little bit. Well, you can also come to my increased webinar on Thursday. We will talk about characteristics of each currency pair. So we will show some exotic pairs and how you can trade it. But be sure to master knowledge about those indicators, because maybe in your future these indicators will help you to determine the price movements and reversals, right? So pay attention to lagging indicators and also to leading indicators. By combining them both, you can be a good trader. Next question: how the red and blue lines has been formed? It's put here. You just need to add in your template. Just, you know how to add. I think that you know how to add EMA indicators. Insert, you go to your platform, then you go insert indicators, then moving averages, and you just enter 40 EMA and 80 EMA, and those are automatically formed. Those lines are automatically formed. So basically what you need to do is just to enter it on your charts. Also, guys, pay attention that you enter correct numbers. If you don't enter correct numbers, your lines can be misplaced. So enter 40 MA and 80 MA, and then just watch, they are automatically formed in my example. So these are 40 and this is 80, 40 and 80. Okay? If you have any further question, don't hesitate to ask me. If you don't have any questions, we can conclude this webinar about those indicators. Now you know what leading indicators are, what momentum lagging indicators are, and how to effectively combine. Don't ever use, again I will tell you this, don't ever use crosses to enter the market. You will lose eventually. This is a EMA, for example, and this is another EMA, and this is the cross. Some traders suggested that you should enter when those EMAs cross. Don't do that because they are lagging, and usually the price will go a little about in your direction, then it will turn down, and you will get another cross, and you can enter down here, but yet again another cross. Don't do that. Just combine them effectively. Yeah. Great. Thank you, guys. Thank you for your attention, and thanks for Admiral Markets. Also, be sure to watch our webinars on Monday and Thursday. Also, don't forget to like us on Facebook page and to follow my analysis on Euro-Dollar every day. So we will see, maybe we will make some of webinars, or I can say that can be a post-market analysis with some setups for next day. Maybe we will do that in future. But from now on, stick to our webinars, and I wish you very good time, green pips, and trade safe, guys. Don't over leverage yourself. Bye bye, and see you. Okay. What is my short target on euro? Well, guys, I'm not short now at the moment on euro. Now I think that the trend has been formed. You went short. Okay, you can be short, but place your stop loss just above 32.80. You need to if you're short, you need to place your stop loss around 32.80 to 83. Well, that is. But I think that we will see. Maybe we see some retracement. But maybe next target will be 33.25. I need to calculate that. Well, it went to 32.70. It went to 32.70. It went to 32.80. Why we had this webinar, it went to 32.80. 31.80. No, at the moment I don't think it will be possible. Only if some major news gets in, that will be 31.70. But if we go below 31.70, we will probably test 31.20 and 31.00. Yeah, it started from there on Sunday, but because of bad NFP results and because of hesitation on attack of Syria, dollar has been weakening. So we had we are having now uptrend. And if you see the price action, you can see that it has been inverse head and shoulders formed. Just take a look on my chart from today. You will see that that is inverse head and shoulders. So we will see. If you are short, don't go for full. I'm not sure where the price will go now, because market is a bit slow now. It's already 7 o'clock. But today I think that we should buy into dips. I will go with my analysis. We can buy into dips. But of course, if you are short, place your stop loss just above 32.80. So okay, guys, we can talk about this maybe in some of our next webinars. So just be sure to follow us, follow the analysis, and don't over leverage yourself. Thank you very much for your attention and for your questions. I will gladly answer all of them, always when you ask. So you're welcome, guys. So we will talk on Thursday. Okay. Have a great time and see you on Thursday. Bye bye, guys.
The